My goal for this free course is to move you from a struggling trader to profitable trader quickly. In my previous videos, I showed you how to read market structure like a pro, just the way the hedge funds manager view it. If you have not seen it, check my videos. You are going to see 2 videos on market structure, and the other one is advanced market structure, where we talked about strong high low and weak high low. And in today's video, we are going to look at the point of interest. Point of interest are simply areas of value on the chart where you want to engage in either a buy or a sell move on a particular currency pair, instrument, or asset class. So without wasting time, we are going to look at how do you determine the point of interest that are of high value. Some people call it point of interest, POI. Some call it area of value. Regardless of the name you call it, they are simply area on the chart where you take buy or sell trades. So now if you look at this particular chart here, we have a market moving down, low, high, creating supply here, taking out this. And in my previous video, I told you the key areas where you should be looking for a point of interest. They are the last supply or demand zone that took out the opposing zone, and then the origin of the move. Those are your best point of interest you can be looking at. Any other point of interest are simply low probability. Now, what do I mean by low probability? Low probability trades are simply trades that have a low probability of what? Success. Does it mean that price cannot trade to another point of interest and move? Absolutely yes. Price can move to any other point of interest aside from these two and still move. But as a trader, you will learn how to use probability in your favor. That leads us to the 3 types of probability that I give my trade setup. So the first one is called a high probability trade. We have the medium probability trade, and the last one, I call it the low probability trade. Now, this does not mean low probability trade means you should not take the trade. What it means is, for a high probability trade, if you are to risk 3%, 2% per trade, for example, let's say 2% per trade, your high probability trade, to you, you gauge it as a trade that is most likely to be profitable. You can risk that 2% on that trade. So when I say high probability trade, it simply means a trade you can put your normal risk on. That, okay, this is a good trade. I'm going to risk my 2% that I allocate per trade. For a medium probability trade, there are some criteria that trade did not meet, but it's still medium term, meaning it's still a good trade. And in this case, you can decide to lower the risk, maybe from 2% to 1%. That trade is simply a medium probability trade. And the last one, the low probability trade, is a trade that there are some certain conditions that trade setup did not meet. Then, in that case, if you are to take the trade, you should lower your risk, probably to 0.5 and below, because they are low probability. Because a low probability trade, in most cases, have a tendency of what? Losing, okay, most of the time. So in that case, if it takes you out, you are simply risking small amount of money. So what makes you categorize a trade as high, medium, or low probability trade is simply your risk management. So now, any other point of interest in here, okay, you can give it a class of what? Probability, either medium, low, and the rest. Okay, so that is what we want to look at first of all here. So within these two, the middle, this first one here, the demand or supply that takes out the opposing demand or supply, I tag it as a medium term. In my previous video, I used the word 50% level. Okay, I use the word 50% level because most times they fall within the 50% of the move that broke structure. First of all, you must have a market structure, either bearish or bullish structure. Then you look at the last demand zone or supply zone. In this case, a supply zone that took out this demand. Because demand pushed this price to the upside, so this supply came in, broke that demand. So that is a key level where you should be looking for trades. And in this case, I tag this medium probability what trade. So if I'm to take a trade there, I will adjust my risks according to the medium probability trade. Now the origin is high probability trade. When price trades back to the origin and I'm about to take this trade, I will take this trade with more confidence or with a higher degree of what probability that this trade becomes successful. And in that case, I'm going to risk my normal 2% or 1% depending on what you risk per trade. So this particular trade here will be termed high probability trade. Now, any other point of interest, if you are to take it at based on any reason, then you can tag them low probability. Like if I'm to take this trade here, I'm going to weigh the different criteria. If it falls within the low probability trade, that will be low probability. I will use a very small lot size here because I've seen it to be a low probability trade. Now, someone will say, how can this trade be a low probability trade even though it's above this one and also is in premium for a sell? Now, from my back testing, I've seen that most point of interest or area of value that are above this and not the origin, most time price sweep that liquidity. I will talk about liquidity in my next video. Okay, so to me, I would rather wait for confirmation. If I'm not taking it as a low probability trade, I will wait for confirmation in here before I pull the trigger. But unlike this side, I will simply take the trade. Once price comes in here, I'll simply take the trade. So your duty as a trader is to be able to categorize your point of interest into high probability, medium probability, and low probability. Now for the bullish move also is the same thing that we're looking at. Our two main points of interest are the what? The origin and what? The flip zone. Now this is a bullish structure because we've broken structure here, we broke structure here. Now if I have to take this trade as a result of breaking this structure leg, our first point of interest is here, which I term the medium term, the flip zone region, or simply call it the 50% region. And then the point of origin, this one is high probability. Now let me correct a particular impression. When I say high probability, does it mean that you cannot take a loss? Definitely you can. There is no trade that is guaranteed. Okay, let me just clear the air on that. Because a trade is high probability does not mean that that trade will not be a losing trade. You use risk management to control your risk, and that is what professional traders does. Okay, and that is my goal in this particular course, so that when you are done with this course, you will be able to know how to approach the market, the right risks to use, and the right mindset in order to deal with the market conditions as it flows. So without wasting time, I'm going to share with you some recent trades that I gave out to my Signal group. If you want to join, check the link in the description, and then you'll be invited in. So we are going to look at an example on Euro NZD trade. This particular trade, you can see that we have a leg of structure here, market took out this structure here. Now, the demand zone that took out that supply here are simply this entire region here. Okay, as you can see, this is the origin. Yeah, if you have to look at the internal structure, but overall structure, this is the origin. But if you are looking at the internal structure, this is the origin, this is the 50% level here, or the last demand that took that out. And you can see when price actually came back into the zone, move up, but on the way coming, that level gave way. Okay, let's assume we take a loss here. Now this is the origin. Okay, now based on this, you can do what is called refinement. Now refinement is simply you going to a lower time frame to look for other point of interest that are within this overall point of interest on the daily structure. Okay, so a particular point of interest can be refined into smaller groups, okay, because you don't want to take the drawdown. The reason for the refinement is you want to reduce your drawdown. Okay, drawdown simply means that number of times or those duration where you are in the negative before the move went higher. Okay, so in that case, you can go and refine. Now in this case, I simply look at my opening price strategy that I taught you on this channel. If you have not seen it, check my videos. Just go to my videos and you look for the opening price trading strategy. So I wanted the price to come back to the opening price here before I take that trade. And as you can see, price came into the opening price. If you go to the 4 hour, you can refine, but in this case, there's nothing to refine there. So this trade to me is a high probability trade. Why? Because price is coming out from what? The point of origin. And you can see price came in and then pushed to the upside. So that is number one trade example. This trade example, I shared it on the Signal channel for members to take this trade. Okay, and as you can see, the trade is already in our favor. Another example I want to look at here is this trade on oil. Okay, as you can see, we have a break of structure here, even though we are trying to trade a reversal, because you can see the entire market is bullish, and then the reversal in terms of the internal structure. But if you can see, we are at the origin here, the origin that started this move up. Okay, on the daily structure, this is the origin here. If you can refine this down here, we are at the origin, and price is in there, rejected, creating a shift in market structure here. So this is an indication that we may start moving higher, okay, to attack all of these highs and then create a new leg of structure. So as you can see now, we are at a very good area. So the trades you are taking here are simply high probability trades. So when price came in the first time, move out, you got your trade. The second time here is where our trade came in. Okay, this trade I took it before I started the trade signal stuff. Okay, and as you can see, price came in. This is we look at the opening price. There's a reason I put it there. If you want to know the reason, put it in the comment section. Why did I put it here? Why is it here? And the short answer is simply a gap. When there's a gap, you maintain the closing price of the previous candle. That's all. So now you can see the opening price wasn't hit until it came here. So now someone will say, oh, look at it, the price came and took out this low as liquidity and then move. There's no problem. What I'm teaching you now is point of interest. I've not even started with the entry criteria. Okay, so you have to be patient when it comes to entry. Now you can see this region here is a high probability trade. Why? This is the origin. Okay, we have the 50% level here. This was, can I tag this area here? Because all of these are gap. Price broke above. So this was the last demand that came in to take out this. Price came in, I gave you an intraday trade here, but eventually price came down back to the origin. Now, if you look at this other point of interest that are, you can see price did not even respect them. If you try to take this trade, you can see the drawdown, or probably must have taken you out with this wick. Okay, so not that you can't take a trade from here, but you have to, in this case, I will have to wait to see a shift in market structure in the lower time frame. But if you go to lower time frame, we are not going to see that. So in that case, this is out of it. Okay, so for now, focus, because you are in the learning phase, you are learning. Focus on this point of interest I'm showing to you. Don't look at any other point of interest for now. Focus on this, the flip zone and the origin. Flip zone and the origin. Now, in my next class, I'm going to show you the different type of what? Point of interest. Okay, we have the order blocks, fair value gaps, demand and supply, and so on and so forth. This is just an introductory aspect. I'm going to show you how to trade those other forms of what? Point of interest. So this is simply an illustration to show you that these 2 points of interest are very, very important. It's going to give you trade if you know what you're looking for. This is a medium term. You can take an intra here. You can see 2 days, 1, 2 of bullish price. This was good profit. The origin 1, 2, 3, 4, 4 days. Retracement a little, and hopefully we should move higher to break out of this structure and then continue this internal structure to the upside. Okay, I want to see this level go. Okay, if we can trade above this, then our bullish move is confirmed 100%. Then this high becomes a target and we move on like that. Okay, so this is what I want to show you. In my next video, I'm going to show you more on the point of interest, the different type of point of interest that you may use in terms of demand and supply, order blocks, fair value gaps, and so on and so forth, and also how to refine your point of interest. On that note, I will see you in these videos.